Cisco Systems has a diverse revenue stream, strong competitive advantages, and a history of consistent profitability. But there's more to this story. In the next minutes, we'll break down Cisco Systems' key financial and performance metrics to help you understand its potential as an investment. Stick around. This might just change how you look at Cisco's stock. Let's start with a quick snapshot of Cisco Systems. Founded in 1984, Cisco has grown into a giant in the communications equipment industry. The company designs and sells a wide range of technologies, from networking to cloud applications. Cisco's product lineup includes secure, agile networks, Internet for the future, collaboration tools, end-to-end security, optimized application experiences, and other products. The company generates 56% of its revenue from networking, 8% from security, another 8% from collaboration, and 27% from services. With such a broad portfolio, Cisco is a critical player in the tech industry, particularly in networking and security solutions. One of Cisco's most significant competitive advantages is its size. Being a massive company allows Cisco to invest heavily in research and development, create comprehensive solutions, and maintain strong relationships with enterprise clients. However, size alone doesn't guarantee success, so let's dive into the financials to see how Cisco is performing. Starting with liquidity, Cisco's current ratio is 0.91, which indicates that the company might struggle to cover its short-term liabilities with its current assets. Over the past decade, this ratio has been on a downward trend, which could signal potential liquidity concerns. Investors typically prefer a current ratio above 1, so Cisco's figure is worth monitoring closely. Next, we have operating income, currently at $13 billion. Historically, Cisco's operating income has shown a slow but steady increase, reflecting the company's ability to generate profit from its core operations. However, it's important to note that there's been a reasonable decline from last year. This drop is likely due to increased competition, particularly from Arista Networks and China-based Huawei. When we look at net income, Cisco has posted $10.32 billion. This figure closely follows the trend of operating income, indicating that the company has managed to keep its expenses relatively in check. However, similar to operating income, net income has also seen a decline from last year, highlighting the pressure Cisco faces in maintaining its profitability. Moving on to net profit margin, Cisco's current margin stands at 19.2%, which is quite healthy for a company of its size. However, this is a decrease from the previous year and is actually the smallest margin since 2018. A declining profit margin can be a red flag, indicating that the company is facing challenges in either maintaining its pricing power or controlling its costs. Return on equity, ROE, is another key metric for evaluating Cisco's performance. Currently, Cisco's ROE is 23%, which, while lower than in previous years, is still a strong number. ROE measures how effectively the company is using shareholders' equity to generate profits, and a 23% ROE suggests that Cisco is still delivering solid returns for its investors. Now, let's discuss Cisco's debt levels. The company's net debt to equity ratio is 0.88, the highest it's been in the past decade. This ratio compares the company's total debt to its shareholder equity, and a higher number indicates increased leverage. While leverage can amplify returns, it also increases the company's risk profile, especially in times of financial stress. Similarly, Cisco's net debt to operating income ratio is 3.25, which is also the highest in the past 10 years. This ratio measures the company's ability to pay off its debt using its earnings before interest, taxes, depreciation, and amortization. A higher ratio suggests that Cisco is more leveraged and could face challenges in managing its debt load if its earnings decline. Despite the rising debt, Cisco has maintained a relatively attractive dividend yield, which is one of the reasons many investors are drawn to this stock. Cisco's commitment to returning capital to shareholders through dividends is a positive, but it's essential to consider whether the company can sustain these payouts given its increasing leverage. Let's take a look at Cisco's valuation. The company's price-to-earnings ratio has been ranging between 12.1 and 15.6, which is consistent with its historical levels. The PE ratio helps investors determine whether a stock is over or undervalued by comparing the company's current share price to its earnings per share. Cisco's PE ratio suggests that the market is valuing the company fairly relative to its earnings, but it's crucial to compare this with peers in the industry. By the time you watch this video, these numbers might be different from when I recorded it, but it's crucial to be aware of Cisco's historical valuation levels. Keeping an eye on these trends can help you determine whether the stock is trading at an attractive level compared to its past performance. Now, let's talk about the sustainability of Cisco's growth. While the company has shown resilience in maintaining profitability, the slow growth in operating income and the decline in net profit margins indicate that Cisco might face challenges in sustaining its growth trajectory. The increased competition and market share loss to companies like Arista Networks and Huawei are significant concerns that could impact Cisco's long-term prospects. However, Cisco's position as a market leader in networking and security gives it a strong foundation to build on. The company's focus on innovation, particularly in areas like cloud computing and cybersecurity, could drive future growth. Cisco's ability to adapt to the changing technological landscape will be critical in maintaining its competitive edge. Investors should also be mindful of the risk factors. The increasing leverage, as evidenced by the rising net debt to equity and net debt to operating income ratios, adds a layer of risk, especially if Cisco's earnings continue to face pressure. Additionally, the declining profit margins and ROE suggest that the company may be experiencing some operational inefficiencies or competitive pressures that could affect its future performance. Remember, the stock market is dynamic, and it's essential to stay informed and continuously monitor the companies in your portfolio. By understanding the key financial metrics and being aware of potential risks, you can make better investment decisions. If you found this analysis helpful, please like the video and subscribe for more deep dives into your favorite stocks. Thanks for watching, and see you next time.